morning, everyone. I'm Zaran Malton, Head of Wholesale at M&G Investments South Africa. With markets at a turning point, understanding where we are in the economic cycle is crucial for navigating the future of fixed income investing. Today, our panel brings together leading voices to help us make sense of the road ahead. Jim Reid, Head of Economics, Global Economics and Thematic Research at Deutsche Bank. Jamie Hamilton, Portfolio Manager at M&G Investments, and Gareth Burke, CIO for Fixed Income at M&G Investments South Africa. Before we can look ahead, we need to understand where we are right now. And we're going to start with a question to our audience. If you can take out your phones and scan the QR code and help us answer today's million-dollar question. Everyone got their answer in? Okay, so starting to flatten out a bit. Seems like most of the audience thinks we're headed for a contraction. Contraction it is. Jim, you're the expert on this, so I'm going to hand over to you to share your thoughts and kick us off.
Makes it a little bit easier for me. Lovely to be here. I thought I would just share my thoughts on just the cycle and things to do with that. First thing, I think economic cycles, I've been looking at economic cycles for all my career and trying to understand them. I'm a lover of long-term data and I try to put it in perspective. But the honest truth is, I think economic cycles have just been kind of warped in the last few years. So if you look at this graph here, this is the length of every US business cycle in the last 170 years. So there's been 35 business cycles. So there's been 34 recessions in that period. And you can see towards the end, in the last few decades, business cycles have got longer and longer and longer. And that's not because growth is higher. It's the opposite. Growth actually has been lower. And look, this cycle already is now in the top 7 longest cycles in history, and it follows 4 very, very, very long cycles. So, why is that happening? What can we learn from it? I think a lot is to do with this graph. Again, if you're probably getting the idea that I like long-term charts. This goes back to George Washington in the 1790s. And before the last few decades, you see the budget always balanced. The fiscal budget always balanced unless you're in a war. Now, the US has had a lot of wars, so there has been a lot of occasions where you had a shock. But outside of wars, the budget always balanced. And that meant that the government wasn't a big player in the economy. So the economy naturally kind of had expansion phases, contractions, and the business cycle was much more frequent, much more regular. To cut a long story short, in the last few decades, I won't bore you with the details, but in the early 1970s, we broke ties with gold, and the globe became a fiat money fiat money system, and that meant that nothing was back in paper money, and you didn't have to keep a certain amount of money reserves relative to gold. So you could start to have deficits. So we started the deficit era. And I think the longer business cycles have corresponded with higher deficits. And if you look going forward, when the US was downgraded 4 weeks ago, Moody's said that they thought the US deficit would be 9% by 2034. Now, to be honest, if we get to 9% from around 6.5, 7 today, then business cycles will probably stay relatively long because you're getting the government helping the economy year on year. I would say, though, that we might be coming to the end of this era because we've now got US debt approaching over 100% of GDP. Nominal yields are now on a par with nominal GDP. So it's, for the last 15, 20 years, nominal yields have been lower than nominal GDP. So that's helped pay for debt and deficits. Now, the debt has gone above 100% in the US. Yields have now gone up. And it becomes more difficult to kind of justify sustainability. And obviously, we've got this One Big Beautiful Bill Act going through Congress at the moment. And at the same time, Liberation Day this year has scared international investors. So I think the US is going to find it more difficult to fund this deficit going forward. Maybe we've got another couple of years, but by the time we have the next election in 2028, I'm not sure there'll be the same ability for a government to get in and say, let's cut taxes, let's increase spending. I think this might be the last hurrah for this really elongated business cycle era. And look, it comes with, as I say, with Liberation Day. If the Trump administration pursue a less globalized world, there are consequences. And I think if you look at this chart here, one of the consequences of a globalized world has been low inflation. So at the point where China joined the WTO, for the next 20 years, there was no goods price inflation anywhere in the world. And I think that has helped business cycles become longer, because if inflation is controlled from external measures, it allows monetary policy to concentrate on other things, help ease the business cycle, etc. But if you reverse that, if you really went to the extreme, then you would argue that a deglobalization era would lead to higher inflation, and therefore central banks won't have the same ability just to manipulate the business cycle. So I think from a monetary and fiscal point of view, we are at an interesting point in the next few years about whether fiscal and monetary policy can have the same flexibility to extend the business cycle as they once did. That's the US. Europe is actually an interesting point. I'll skip forward a few slides. I want to make sure I don't overstay my welcome. Europe has really had a great year so far. It's outperforming the S&P by pretty much the most it has done since our daily data starts in 1960. But Europe hasn't had the same kind of long business cycles as the US. And the biggest country in Europe, Germany, has had awful last 5 years in terms of growth. So this is all the countries I have data for globally in GDP terms, and you can see in the last 5 years, Germany has averaged basically zero growth. So appalling, really, for a really major economy, one of the biggest economies in the world, one of the most successful. It should be at the heart of Europe, but it's been a disaster. The good news is that the new government, to be honest, provoked by Trump, so Trump would take a lot of credit for this, has announced $1 trillion of fiscal spending in the next decade. And I think this will mean that Germany will be kind of immune from some of the business cycle pressures in the next few years. So we have Germany growing at 2% next year, which is it's amazing for relative to the last few years. And that growth should continue at least for the next few years. But to really help the cycle, Europe does need to do massive structural reforms. So this is just one example of that. This is the average hourly hours worked per employee in all the OECD countries, and you can see it is quite embarrassing that Germany is at the bottom here. And I'll let you into a little secret. I work for Deutsche Bank, and if it wasn't for Deutsche Bank, this would be even lower. We bring this up. Last week I worked 32 hours, and I'm helping this average. But the serious point is, Europe is going to have an opportunity now for growth because of German fiscal spending, defense spending, and that will help the business cycle. But there is a lot of structural reforms that need to be done in the background to kind of maintain that going forward. And just to illustrate and to end on the last couple of slides, business cycles are very easy to extend if you've got growth momentum and high growth. They're very difficult to extend if you've got low growth. And what this graph shows you, over the last 25 years, there is a very good correlation between, on the x-axis, the growth in the working age population, and on the y-axis you've got economic growth. So to cut a long story short, you don't want to be down here. These are the countries that have low working age population growth, and it's been proven that that is very well correlated to low economic growth. So it's much more difficult to maintain the cycle if you've got less people working, and much easier to maintain the cycle if you've got more people working. And the problem in the next 25 years, this is all countries now, and sorry, the scale, it's only given alternate countries here, which isn't very helpful, but the point you can get across in the colour code, in the grey countries are emerging markets, and the blue countries are the developed world, and lots of developed world countries, plus a few Asian EM countries, have a decline in the working age population in the next 20 years, 25 years. And mostly emerging market countries have a better outlook for working age population growth. So it is going to be easier to maintain a business cycle and maintain expansion if you've got a lot of workers. And unfortunately, the world is moving probably in the opposite direction. So that's some of the structural problems that we've got to face. And without picking on Europe, Europe has to find ways of getting more people in work, either through increasing retirement ages, having a more mature debate about immigration, or maybe AI. But maybe that's a topic for another day. So on that, I'll pass you back. Yeah.
Thank you, Jim. Thank you, Jamie. To build on what Jim says, how is the economic uncertainty affecting your day-to-day in corporate bonds? How are you seeing corporate bonds react in terms of spreads?
Well, I mean, it should be relatively straightforward. Everyone in the survey seemed to be heading towards, we're going into a major contraction. That should be quite a difficult time for corporates. You should be getting a bit more defensive. But, when we look into corporate markets, they are trading up close to all-time highs, very sanguine about the outlook. And certainly if you look at official statistics for defaults for investment-grade companies in particular, they are very low. So we've had 10 years for people to repair balance sheets. And I think that strength of the market does seem to be very much at odds with where we sit in terms of an economic contraction. And I think possibly what brings those two things back together, we are seeing some cracks starting to appear. So if you go and look at the micro data, credit card charge-offs, the early warning signs in the US, you are seeing some deterioration beginning to come through now. But I think also when you look at default rates, the behaviour of borrowers now, when they do get into difficulties, we are seeing quite a lot of coercive behaviour in terms of investors being asked to accept fairly significant detrimental LME exercises and exchanges. So I think if you add that in, probably the corporate picture does look a little bit less good than it appears from the official numbers. So we would probably strike a bit of a note of caution in terms of the euphoria that there is in the corporate bond market. It's a little bit darker than I think possibly it appears to be, and you need to be, I think, a bit more selective in terms of the corporates you're looking at.
Thank you. Gareth, I'm going to hand over to you. So South African bonds have performed well recently. How are we seeing these global shifts affecting the South African bond market?
Well, I think well is an understatement. I mean, if you think 13 to 14 months of what the local market has done on that side, we've probably rallied 200 basis points. So the SA bond market's had a stellar kind of year or so in terms of returns, probably one of the best performing bond markets, local bond markets in the globe. And that's all been a domestic story. So that's very much around the political ramifications of the election last year, which we're all familiar with, and the formation of the Government of National Unity, and effectively the tail risk that got priced out of the market essentially over that period as the investor community looked forward to structural reform and that kind of populist part of risk of the political situation falling to the wayside. So that's really driven the market. It hasn't been one-way traffic. I mean, that positive sentiment petered out towards the last quarter of last year. And obviously we've seen kind of the challenges more recently in the beginning of the year with the budget and the debacle that we had there, and that the risks around that political situation again around the GNU and those risks coming to the fore again. Put that at the same time, we've seen the global impact. We mentioned Trump earlier and Liberation Day and tariffs. Obviously, South Africa has been in the focus of the US administration, so we're in the crosshairs and have been, although that seems to shift a bit as topics have changed over that time. But that's also clearly impacted us in terms of the local market and what the outlook has been for that market. But really, it's been domestic development that's really driven performance in the bond market more recently.
Okay, awesome. Jamie, I guess you erred on the side of caution when it comes to corporate bonds, right? Have we seen the tariff regime affect sort of, and the supply chain disruptions that comes with sort of geopolitical uncertainty affecting corporate bond issuance and reinvestment risks?
Well, not a great deal so far. I mean, most of the companies that have come out and are reporting, the potential impact. Obviously, it's very difficult to say exactly what tariff regime is going to eventually come in. Most of them seem to feel, again, at a sort of investment grade level, larger global corporates, that it is manageable outside of some very specific sectors. So we haven't seen a massive impact come through yet. But I'd reiterate what I said before, these things are uncertain. And I think that at the margin, given pricing for corporate bonds is, generally speaking, fairly generous at the moment, I would imagine that, again, you want to be cautious about. It's just another uncertainty out there that possibly isn't priced in, particularly to lower rated corporates.
Awesome. Jim, do you have anything to add to sort of the thinking in terms of both credit and South African bonds?
I wouldn't say I was an expert on South African bonds, so I'll probably avoid that. Look, in terms of credit, I think credit has a history of staying very tight for a very long period of time and then suddenly widening out. Now, if it was a kind of a university textbook, you probably should have credit that slowly widens out as the risks get bigger and bigger and bigger, but it never really works like that. The market tends to stay very, very tight until it doesn't. So the danger that our strategists, fund managers have is, you can see those risks building, and you know that it's prudent to lighten up, but you know that the market will probably stay tight for too long, and it's kind of picking the pennies up in front of the steamroller. And I think that's probably where we are at the moment, but it could last another year, it could last another 18 months, and I suppose the skill is to try to find ways of still getting a performance while that period is there, really.
Yeah. Building on that, picking up pennies in front of the steamroller, what's your thoughts, Gareth, in terms of both global bonds from a South African investor's perspective, and then the reverse? Like, if you were managing it, how would you think about South African bonds? Where's the opportunity set?
Well, maybe I can just talk to you. I mean, I think that talks to positioning and how we position across our portfolios. So if we think just from domestic portfolios and how we positioned with respect to South African bonds, in our multi-asset class portfolios, our balanced funds, our real return funds, we're overweight bonds. And the reality is that SA bonds are offering you very high real yields. So if you think kind of the longer 10, 20-year bonds are offering you somewhere between 10 to 11%, you see inflation, pick your number where you think it is, but you're probably looking at a real return north of 6% that's currently pricing in. So relative to what you can find around the globe, that's a very attractive real yield. And so we're overweight bonds in our domestic portfolios, and we think that's an attractive return profile for those balanced and real return funds. If we then look across what we're doing in our global portion of our funds and looking out in particularly in developed markets, we're long duration in selected developed markets. So if you look at the US, for instance, the UK, those developed market bonds are actually paying you a return now. If you just go back a couple of years ago, you weren't getting paid at all. And so there's been a significant repricing in that market, and we do think there's opportunity there. So we're overweight duration in those markets. I think for a global investor looking across the globe and looking for opportunities, I think if you think about the backdrop in terms of the US exceptionalism being challenged, you look at the Fed in a rate cutting cycle, so supportive of emerging markets, and a dollar that's been depreciating after a number of years of many years of strength. I think those are all supportive of emerging markets. And so if you looked at our emerging market portfolios, you'd see that we had overweight South Africa, for instance.
Thanks. Jamie, I'm going to hand over to you and ask, are there any sort of sectors or regions that are, in terms of credit, that's sort of keeping you up at night or getting you more excited? Like, where are you finding the best opportunities in the credit space at the moment?
Well, I mean, the interesting answer to that is, I mean, it's certainly not all doom and gloom. And fundamentally, it's not really the sectors that are necessarily in the sort of headlines at the moment. It's at the moment you're reasonably well rewarded to go down to the I suppose the lower risk areas. And actually, given that a lot of the return is really coming from reasonably generous government bond yields, underlying government bond yields, you can still find some quite attractive all-in yields without taking a great deal of risk. So I think you're well rewarded at the moment to look at. You can pick up a lot of quality in your portfolio, avoid a lot of risk at the moment, without really giving up a lot in the way of return. And some of those perhaps slightly more boring instruments, you might think, are probably going to be a better place to be over the course of the next year than reaching for yield, classically trying to pick up pennies in front of the steamroller, perhaps reaching out. Now, there are always individual opportunities within that. Some areas of the high yield market, for example, have already started to respond to that contraction and sell off aggressively. So there are individual opportunities we can pick up, but generally across our portfolios, you're looking at trying to improve the credit quality of your portfolio so that you'll be able to take advantage of the volatility that we expect is coming.
Okay, thanks. Jim, if I could turn it to you, you touched on some of the structural trends happening in the market. And I think we wouldn't be maximizing our time with you if we didn't ask you sort of, how do you think these shifts in demographics and the rest are going to affect economic cycles going forward? You said we're in one of the longest cycles so far, so where's your thinking around that?
Yeah, I think demographics, splits opinion in terms of its impact on markets. My long-standing view is that the very, very good demographics we had globally up until probably the middle end of the last decade, i.e. working age populations growing everywhere, including China, and China was an important one, that reduced inflation, because what it did is it gave the world a big pool of labor. And with China integrated into the global economy in the last few decades and having a huge demographic growth, it basically gave the world a lot of cheap labor. And that helped lower inflation along with globalization. I'd worry going forward if we have seen a peak in globalization, which is still up for debate. I mean, who knows what Trump will do? But I think most people think at best we're kind of plateauing on globalization. If that happens at the same time as demographics, which is more guaranteed because we know what the demographics will be because it's obviously predictable, I worry that that reduction in demographics or deterioration in the number of working age people is actually going to raise inflation because you've got less cheap labor, and that means higher wage costs. Now, please don't quote me by saying that people getting paid more is a bad thing. It's not at all. It's obviously a very good thing, especially for people that are lower paid. But it probably does make it more difficult to manage the business cycle because you have to be more aware of inflation. In the last few decades, central banks and governments have been able to do really what they want because inflation has been controlled externally, I think, by globalization and demographics. So if those two things are starting to turn, it makes it more difficult to manage economic policy, I think, going forward.
Okay. Gareth, do you see any of those trends impacting South African bonds?
Look, I mean, if you talk about inflation, and maybe specifically, I mean, inflation, as we sit at the moment in South Africa, is clearly under control. We're printing kind of at the low end of the target, around about 3%. And the talk in South Africa specifically is all around, currently, around the change in the inflation target. And so, we've had this range of 3 to 6, and the SARB has come out quite forcefully now in arguing for a 3% target. And we saw in the recent MPC, quite surprised the market, and you've seen the market react on the back of that as they've seemed to really forcefully put forward the case for a move in that target. So I think from a regulatory or a monetary policy position, I think the SARB is very much focused on getting inflation well contained, and there's a question as to where Treasury will move in terms of moving that target. So I think kind of structurally there's a move to get inflation lower in South Africa. Obviously the global impact. We're a small open economy. There's going to be some impact on that side, but I think certainly a lot of the work that SARB has done is what's quite important in driving those inflation expectations is where the target is. So yes, I mean, I think looking at those demographics, obviously SA has a growing population, but the challenge for us, I guess, is education on that side, and I think we've squandered time that we've had, or a youthful population that we've had, which would have benefited the country. So I think it's important. Yeah, the demographics are important, but it's also important making sure that there's education to back that up. And who knows, maybe AI will be a solution to some of that as we go forward. But yeah, I think certainly from where we sit now in respect of SA bonds, inflation is actually well under control.
Thanks. Jamie, I'm going to throw one at you now. I mean, there's a lot of factors to consider when being a fixed income manager. And then if you add ESG and sustainability into the mix as well, how do you factor in all these plus that into your decision making and finding the opportunities?
Well, I think it depends on the sector is the answer to that. I mean, there are a lot of sectors, you take the utility sector, for example, where I think our sector specialist analysts would say they have been ESG experts for 20, 30 years. That's always been the main driver of your credit risk profile for a utility company. There are other sectors where it is not these sort of risks are not necessarily something that have been taken into account so much going backwards. But there's no short answer to that. The way you bring them into your decision making is it's a research exercise. It is very resource intensive, but increasingly a lot of those risks are in those sort of sectors fundamental to getting your money back at the end of the day. So we make our analysts responsible not just for traditional credit risks that you might look at, balance sheet type risks, but increasingly they're looking at the whole picture. And what we want out of them is one overall assessment of the credit risks of a company, and that includes increasingly a lot of ESG factors.
Thanks. So we're running out of time, but I'm going to ask you guys if there's one thing you wanted to leave the audience with, your closing thoughts, both on both demographics, trends, or even just bonds, what would that be? Start with you, Jim.
I think we've probably come into the slow end of US exceptionalism. The US dollar has probably been overvalued quite heavily for 3 years now, but historically you always need a catalyst for that to correct. And I think the Trump administration's policies, given that the US has a huge twin deficit it needs to fund, is going to put off overseas investors, and they are going to want a cheaper dollar. Now, it's not, oh my God, the US is going to collapse. It's a relative game, because when I did my 2025 outlook, 6 to 8 months ago, everybody, his dog, his sheep, his cat, his monkey, wanted to be long US assets. Everybody. Nobody wanted to touch European assets or things like that. And if you flip over 6 months, there is a lot of question marks on that. Now, I don't think a lot of US assets have been sold, but I think as people are constructing portfolios, as asset allocation teams are meeting, I think they're looking to now, where else can I invest? And that wasn't the conversation 6 months ago. And, that's an opportunity for the likes of South Africa probably to try to attract, people inflows in a world where people want a bit more diversification.
Jamie?
I mean, I think I'd pick up on a lot of what Jim's been saying. It's an uncertain time. It's going to be an exciting time in the next 5 years. And I think your mindset going into that shouldn't be one of, what am I going to commit to today? What am I going to lock my investments away in? The key is going to be remaining reasonably flexible and having then the ability to take advantage of these opportunities when they come up. So whether that be being reasonably flexible about credit, hiding occasionally in more defensive places, the key is being able to redeploy into these opportunities when they come along, rather than trying to jump on what's available as of today.
Thanks. Gareth?
When I'll touch on that, essentially just focusing on the price you pay for what you're getting. So valuation is key. And that's what you need to focus on here. These trends and these market gyrations are going to go, and going to be then the surprises are going to come. But you need to focus on a valuation anchor, at least, to help you guide you through those periods. And so that's key. Look at the price you pay for what you're buying.
Awesome. We have 5 minutes for questions from our audience, so I'm going to open it up to any of the... There we go, Roelof.
Thanks, gentlemen. You've done well. I think the question in our minds is the opportunity set. And Asian bonds comes to mind. Chinese bonds have done well over the last 12 months on a basically low vol and absolute return basis. But it's the opportunity set in Asian bonds or emerging local currency bonds. I know we're talking long term, but is the price correct?
I mean, I think that probably comes under the heading of what I was talking about more generally a minute ago. Undoubtedly, it's an area where there are going to be significant opportunities over the course of the next cycle. It is the cycle that will probably really bring that market into the sort of mainstream in terms of, if you're looking at a global bond market set, we are focusing more and more with our colleagues in Singapore on opportunities there. I wouldn't necessarily say that now is the perfect entry point in terms of pricing at the moment. As you say, a lot of those markets have performed reasonably well. There have been significant recoveries from the bottom in terms of sentiment around things like Chinese real estate, which drives a lot of the underlying risk in the particularly the lower end of corporates in that sector. So not necessarily the time to charge in fully at the moment, but undoubtedly an area where over the next few years there are going to be bigger opportunities than there were in the last cycle.
Thank you, Jamie. Any more questions from the audience? There we go. Sure.
Hi. The first kind of hypothesis that I wanted to put to the panel has been almost touched upon by the first question. But what do you think of the idea that you should dump developed market bonds as a whole because of the fiscal position of governments and focus far more on emerging market sovereigns and credit? And then secondly, I wanted to ask on the demographics, whether you would believe in the hypothesis that developed market demographics get solved by the AI revolution.
Okay, so two questions there. I think the second question, Jim, if you could take...
On AI?
Yeah, and demographics.
Yep. I'm pretty bullish on AI, but I think it will take a bit longer to really make a difference than people think. And the other thing I would say is that, again, I'm slightly biased by being an economic historian. When you look through history, people always get worried that AI is going to replace labour. And what tends to happen is it creates new opportunities and new workers. So I see it more from that angle, that I think some of the fears that it's going to destroy labour is probably overhyped. I think it can help labour and it can help find more workers. I'm not convinced, though, that it's going to necessarily completely offset a bad demographic. So I suppose I'm in the middle of it, really. I still think demographics matter, poor demographics matter, and I think AI will take longer to materialise in a positive way than people think at the moment. But I don't think it will destroy jobs. I think it will create other industries, etc. So a bit of everything in that answer.
Jeremy, you want to take
on the bond market side of dumping, there's no question that it is a bit of a horror story at the moment in terms of government spending plans. Really, wherever you look, even if you look out to Asia, which we had as a saver for a long time, the Chinese fiscal position obviously is somewhat worrying. And you could say, well, I'm just going to run a mile in that situation. It is worth bearing in mind that a lot of that has been with us for 5 or 10 years, certainly now, and that doesn't mean we can't still have a cyclical influence coming into government bond markets. So when you look at, the UK is one of the most sort of extreme examples of that trade-off between the fiscal position and growth. And, you have 10-year yields in 10 years' time at the moment priced at, above 6% in the UK. So quite a lot is priced into those markets. I think we can still have that long-term, very negative picture, but still have periods where you accept that actually, if you do need some yield, you are being paid a fairly significant yield in certainly the UK, but the US to some extent, a little bit less so in Europe. But I don't think it means that we've just got a negative picture overall for government yields.
But I do think, given what we just talked about here, it does make emerging markets look much more attractive than was in the past.
We're out of time, so unfortunately we won't be able to take... Oh, okay, one more question.
I just want to add on to that question. I've really seen the correlation between global equities and global bonds go up South African investors typically invest in when they go offshore, which is global equities, probably doesn't lend to that investment thesis around the correlation diversification. I just wanted to ask you guys, like, do you still think there's that correlation benefit associated with the asset class, you know, in the near future? I don't know what the longer term picture looks like.
Tough one. Who wants to take that one?
Well, I mean, I certainly think there's an element of that, and that relationship, that classic cyclical relationship, probably has broken down a bit. So I think it's maybe less efficient than it was before. I still think there are elements of there are scenarios that you can put forward where equity markets do come off substantially, and we do get a major problem where bonds do provide something of an offset to that. You know, and again, that's the idea that it's not all about government deficits. There is still a potential for them to defend you from a cyclical point of view, and global bond yields could come down.
Sure. Anything to add, Gareth, Jim?
No, I think that's right, and I mean, I think I think I mentioned earlier in terms of at least how we positioned in the offshore portion of our portfolios, we do have duration on that side. So, yeah, definitely think there's value there, and I think there is some of that protection that is still exists there.
We've run out of time. Jim, Jamie, Gareth, thanks so much. Please join me in welcoming our next speaker, which is Gotham Samoth.